two speakers with us, Marco Vittel and Teemu Pennanen. We begin with Teemu, which has been come from Rio from a couple of times now. So Teemu is in King's College, and as I understand, has his whole consultant company. And he's going to talk to us on indifference swap rates and incomplete markets. Teemu, thank you so much for coming.
Thank you very much, and thank you for the organizers, if there's any in the audience. It's a pleasure to be here. So I changed the title. The first part is pretty much exactly the same as last year, but I'll try to run quickly through that so you won't be too bored, because I'm sure you all memorized it all. So I will concentrate more on, I think, at least two applications that we did since then, where we tried to illustrate the theory numerically. Last year I looked at the duality part, I believe, and then more the mathematical aspects, which is interesting too. But today I think I will just look at the first two applications. The first one is really the main topic of the talk. That's joint work with Maria Nogueiras from HSBC in London. And there we look at setting the swap rates for overnight index swaps on the EONIA rates. So that's a purely numerical study. The second one is joint with John Armstrong from King's College. And there we look at the S&P 500 options. And that's another simple application where you can nicely illustrate the properties of these indifference prices and the hedges. So essentially, the mathematics that I'm going to run through here starts basically from scratch, so square one, assuming that we don't know anything about financial maths. And I partly do that because it's such a simple thing to do. It's easy to understand. There's not much, well, there isn't any sophisticated mathematics. And also because I'm going to have to change some of the fundamental assumptions that are in most models of financial mathematics that you see in books and papers. So the main topic will be on valuations, and I will try to convince you that there is this, you can study valuations, whatever they mean, in a coherent risk management framework, which actually focuses on optimal investment with liabilities. So I will call that the asset liability management problem, but it's nothing but optimal investment over time in a finite discrete time model with liabilities. And the inclusion of liabilities is essential if you want to go into pricing and hedging of derivatives. And what we end up with is a generalization of the classical financial asset pricing models, where you do recover the classical risk-neutral prices as a special case if you specialize your model far enough. Here's a short list of papers that this talk is based on. The main reference is the first one, which is just on the mathematical theory. And then the numerical applications, which will be the main focus, are these two manuscripts here. The first one with Maria and the second one with John, looking at the swaps and options, respectively. And then the third application that I had there is defined benefit pensions that we worked a lot with my students in Finland and did some consulting for pensions companies there. And then the duality part would be based mostly on this joint work with Ari-Pekka Perkkiö from Humboldt University. So, just as to set the stage, as you all know, the classical paradigm in financial mathematics is the risk-neutral valuation, where you essentially assume that you can replicate option payouts by trading. That's what happens in the Black-Scholes model and many extensions of that. And in that particular setting, it happens that there's only one sensible price for selling or buying the asset, assuming you can replicate it. And then, if you go through some more sophisticated mathematics, you can express the prices in terms of as expectations under the so-called risk-neutral measure. And here it turns out that prices are more or less independent of any subjective factors. They don't depend on your views of the market developments. They don't depend on your risk preferences. And what's maybe even more surprising, prices don't depend on your current exposures. So this kind of pricing does not explain why would you trade in the first place. Like if you think of any standardized financial product that is traded in the markets, they have been created exactly for different agents to hedge their positions. Insurance contracts are there to hedge against the insurance losses that you may occur. Any futures contract on anything has been introduced to the market so that you can hedge the future price risk. But the classical math finance doesn't really explain this at all. And then if you look at the actuarial valuations, which is another largely disconnected industry from financial mathematics, they are now converging, but traditionally they come from the opposite direction, where you assume that essentially nothing can be hedged, nothing can be replicated. So, except for fixed income instruments. So what they do there is often, you must have heard of the way they price, for example, pension liabilities. They take discounted expectations. So when you hear the word expectation there, it just means that they essentially filter out all the uncertainty. And that's now lost forever. They lost the essential information in the products that they are pricing, and then they just discount with something like a zero curve. And now there's actually a big discussion that what discount rate should you use? And they are seriously talking about this. That's the important question for them, but they, not knowing enough about financial mathematics, they don't understand this. It's just a trick question. There's no answer to that. You cannot find a consistent zero curve or any discount curve for pricing pension liabilities. And of course, everybody who works in practice knows about these limitations of these classical valuations. And then what they do in practice, they add some adjustments, for example, credit valuation adjustments or funding valuation adjustments. They do realize that the valuations are incorrect, so then they want to adjust those valuations. And the same kind of thing happens in the insurance industry, where they add a risk margin to the discounted expectations of pension liabilities. So they think that since they ignored the risk, now they have to account for it, and they add something to it. But that may make things even worse, because if you think of anything, something as simple as a European option, if you price it by discounted expectation, the price is already too high. If you add a risk margin to it, it's even more incorrect. It's not just that. You must have heard of the pro-cyclicality of these accounting principles in pensions, and that's a real problem during financial crisis. And it just goes back to the incorrect valuation based on discounting with market rates. When there's a financial crisis, the rates usually go down, and then the liability values go up, and that creates even more problems. And there's no reason for the pension liability values to go up during financial crisis, really. So instead of trying to correct the incorrect valuations, we start from scratch and try to change the model so that it accounts for something like credit risk and risks that you cannot hedge in general. So for simplicity, I will work in a finite discrete time, have a filtered probability space, and I have this very simple abstract setting which ignores many of the interesting features of financial markets, like the assets, but already with this simple setup you can study the basic properties like arbitrage bounds and so on, which is I will focus for 5 minutes. So we assume that the market is described by a convex set of sequences of cash flows that can be hedged by trading in the market. So they can be super hedged by trading in the market. And that's essentially all the information you need to know to study the basic properties of pricing and indifference pricing. If you look at the classical models where you always have some numerator asset which is perfectly liquid, price is always strictly positive, you can use it as a numerator. And then essentially it means that the set of sequences of cash flows you can hedge can be expressed like this. That is the sequences who sum up to something which are super replicable terminal payments. And that's what you see, for example, in the Delba and Schachermayer book or the Filmer and Sheet book, which start by assuming that there is a cash account. More general models have been studied by Dermody and Rockefeller, Jaschke and Kühler, Jouini and Knapp and Madan, where they looked at more general sequences, or they looked at the space of sequences of cash flows without assuming the existence of a cash account. They assumed the conical market model, which essentially accounts for bid-ask spreads and proportional transaction costs. What I'm going to do is just to go one step further. I assume that the set here is not a cone, but any convex set that contains the non-positive sequences of claims. And that's essentially it. Well, just one more example. This is what you see in the Filmer and Sheet book, for example. That fits in our framework. It's the sequences that can be, whose cumulative payments can be superhedged by dynamic trading. So there's some trading strategy adapted to the filtration so that the stochastic integral, i.e. the terminal value, dominates the cumulative payments. So that's a simple example that you should keep in mind. What motivated me to look at these non-conical models are these limit order markets. This is a limit order book from the Copenhagen Stock Exchange for some telecom company. And it just shows the marginal prices as a function of the one additional unit if you submit the market order of certain size. So here, the total cost would be given by the integral of this marginal price curve, and that's really a non-trivial, non-positively homogeneous convex function, which results in non-conical sets of claims that you can superhedge for free. So then this is the main object of study. This is what I call the ALM problem in this very abstract setting. So I'm now considering an agent who already has some financial position. And that financial position is described by the sequence of liability payments that the agent has to make. So the payments could be positive or negative. Negative payments would be income to the agents. Negative are really liabilities. And what the agent tries to do is to hedge the C, his initial liabilities, by trading in the financial markets. So that means that he can subtract from C any sequence of claims he can superhedge for free. So the D has to belong to the set of claims he can superhedge. And then what he's trying to optimize is some measure of risk on the space of adapted sequences of cash flow. So this C minus D would be his net liability payments he has to make after he has traded optimally. And then there's some risk measure on the sequence of payments that we try to minimize. One example could be, for example, the expected utility every time step, and then you just sum them up somehow. So that's the problem. I will assume that the risk measure is convex, non-decreasing, and it vanishes at the origin. It's not a big assumption. And that's the ALM problem. And now much of everything that I'm going to say about pricing really comes down to the properties of this function. So it's the optimum value function for agent with initial liability C. Then he trades it in the market and gets an optimal value, and I denote that by phi of C. So it's a convex function on the space of adapted sequences of cash flows. That's the main thing. And it really is a convex function. It's nothing but simple algebra to see that. What plays an important role in non-conical models is the so-called recession cone. It's a classic notion from convex analysis. It's essentially the largest convex cone you can fit inside the convex set C. If the convex set C is already a cone, which happens if you have proportional transaction costs or just bid-ask spreads, then it's already a cone, and the recession cone coincides with the set C itself. So that's why you don't see recession cones in books in financial mathematics, because they almost always assume conical models. So these guys only come up in these non-conical models. But you really do need that if you want to extend the classical arbitrage pricing bounds to the non-conical case. And this lemma here essentially gives all the properties we need of the value function when it comes to pricing. So like I said earlier, this function as a function of the liabilities on the space M of adapted sequence of payments is a convex function, and it's non-increasing in the direction of the recession cone. So if the agent adds anything from the recession cone, he can only get happier. Those he can always hedge without any cost. And in particular, we get from this that the value function is constant on this linear space. This is the largest linear space you can fit inside the set C. In convex analysis, it's called the lineality space of the set. And here's, again, the classical model. This was the set of claims you can superhedge for free, and this lineality space is the set of claims which can be replicated. Well, if a claim can be replicated, then it belongs to this, and the converse holds under the no arbitrage condition. This is the only place where you need the no arbitrage condition. Well, even here you don't need it. It's just a remark that if it holds, then it's if and only if. But from now on, you can forget about arbitrage. It's not important in these illiquid market models. So then to pricing, what the actuaries did do well was to separate two notions of price. One is what they often call the reservation value, or, well, there are many different values. It's something like an accounting value that has to go to the financial statement of the company on the valuation of their liabilities. But that can be very, very different from the price that the company would be willing to pay to trade these claims. For example, to buy a reinsurance contract, it might be the price that they would be willing to pay for that could be very different from the accounting value. So I will make a distinction between the two things. The second thing will be the indifference price, and that's sort of what would be more relevant in trading. The first one would be more relevant in financial supervision. And both are subjective. They both depend on the risk measure I had, they depend on the probabilistic model, and they do depend on the initial position of the agent. So they are all subjective. And of course, many people who work in practice, they are not comfortable when it comes, if they have to impose some subjective features in a model, but I think that's a mistake. Finance is subjective, and I think it's the subjectivity which is why financial markets exist. People trade exactly because they have different valuations for the same asset, and that creates incentive for trade. If the market was complete, everybody had the same views and they had the same valuations, they would have no reason to trade with each other. So trying to ignore the subjectivity just leads to confusions, and you shouldn't do that. So what is the accounting value? It would be the least amount of cash you would need to add to a liabilities in order to, you asked a question that if an insurance company went bankrupt and then a third party would have to take on the liabilities, how much money should be allocated to this entity to be able to run the insurance claims to run off and pay them with low enough risk? And that's the accounting value. So you look at the liabilities, you add something, you subtract some amount of cash from today's payment, and then you want to end up with good enough value in the asset liability management problem. It's exactly the same notion as in the classical paper by Arsney, Delbine, Aber, and Heath when they defined the so-called risk measure. The only difference here is that instead of looking at the one period setup with a cash account, we're looking at the multi-period setup without a perfectly liquid asset. Otherwise, it's exactly the same thing. And then you can derive arbitrage bounds for that. And in complete markets, the arbitrage bounds call up to a single number, and these accounting values have to be equal to that, but not in general. And then the other notion is what I wanted to talk about today is the indifference price extended to swap contracts. So we will be looking at indifference swap rates. So now we're looking at financial trades where, unlike in classical options pricing, where you pay something now in order to exchange for a random payment in the future. We're now looking at trades where both what you get and what you pay may be sequences of payments, possibly random sequences of payments in time. So that's what swap contracts are. And much of trading really, in practice, are swap contracts. And obviously any classical options are just special cases of this. And there are interesting cases where both the premiums and the claims in the contract that are exchanged are stochastic. That happens, for example, if you look at credit derivatives. The claim part would be the insurance against the default of the reference entity, and the premium sequence would be constant until the time of default, after which is 0. So both sequences would be random because the time of default is random. And this is what I mean by the indifference swap rate. So we are looking now at an agent who already has some financial position. I denoted by C bar. I hope you can see the bar on top of the C. And now the agent asks a question: that does he want to enter a swap contract where he would have to pay his customer a sequence C, now without the bar? That would mean that that would add to his liabilities, and in exchange he would get some constant multiple alpha of some premium sequence P. And now the question is that what would be this alpha, the swap rate, so that the agent would be indifferent between entering the contract or not. So that's what this inequality means. This is how happy the agent would be after entering the contract, and this is how happy he would be before, without entering it. And of course, it doesn't make sense for the agent to enter it unless, if this inequality is satisfied. He only enters if it makes him happier. And then you look for the least payment that he would be happy to accept. And that's the indifference swap rate. Now, if you specialize to the case where the premium is paid all today and the claim is paid at maturity, then you get the classical indifference price studied at least as early as 89 by Hodges and Neuberger. And then you can define the indifference swap rate for entering the opposite side of the swap contract as well. And then you can get these arbitrage bounds for those two. So this would be the seller swap rate, this is the buyer swap rate. The buyer swap rate is always less than the seller swap rate. Again, here now we're looking at a single agent. So this just means that it doesn't make sense for the agent to sell to himself, which should be clear. If you're looking at two agents, then these things might cross, and then that creates an incentive for trading. And to get these arbitrage bounds, you have to be now a little bit careful in defining them, because we are looking at non-conical market models. And if you want to get these bounds, this is the definition. This is the super hedging swap rate, and this is the sub-hedging swap rate. They don't depend on the views of the agent or the risk preferences of the agent or the initial liabilities of the agent. So if those two arbitrage bounds happen to be the same, it follows that these indifference swap rates are also independent of these subjective factors. But only then. In general, they are different from the arbitrage bounds. And that's exactly because of this subjectivity. So here's just an example again in the classical model for when does this replicability condition happen. And in the classical market, it happens exactly when the claim is replicable or attainable, or what do you want to call it. And then the applications. Here's the first one. Was implemented by Maria. So we are looking at the Euro overnight index average, which is the lending rate overnight between between banks. So it's the interbank overnight lending rate in Europe. We are looking at these swap contracts on this Eonia rate. And we are doing this indifference pricing for these. And the hedging instruments here will be the investments in this overnight index as well as swap contracts that are available in the market for this overnight index. And then we are trying to find the indifference swap rates for other, maybe OTC swap rates. So here's a simple, up to there is historical overnight indices, and this is a simple model that we developed for that. So the blue curve here is the Eonia rate, the overnight rate. You see these heartbeats, they're called heartbeats. This happens, this spike often at the end of the night of the month because of some regulatory reasons. The red line here is the European Central Bank deposit rate. So that gives a lower bound for the interbank lending rate. If you need to lend money, the worst you can do is to go to the central bank, in the sense that it always gives you a worse rate. So you might want to trade with a commercial bank even at a negative rate, because it's still better than the central bank rate. Since last, I think September last year, the rate has been minus 0.2, and I heard that this week it might even drop to minus 0.3. And what we did here in our model, we just modeled the spread of the overnight index to the European Central Bank deposit rate. We modeled that we modeled the spread with a simple Black-Karaszynski model. So it's like a shifted Black-Karaszynski, shifted by the European Central Bank deposit rate. You could have better models, it's just an example. And here's the swap data. We took for simplicity, the mid-swap quotes, used Bloomberg data. And in this first example, we just have 7 different maturities for the swaps. And those are the hedging instruments in addition to the deposits we might make in the overnight rate. And in this case, the set of claims C that we can superhedge for free is given by this. So what you have here, capital K is the collection of swaps traded in the market. So those are the swaps for which we have the quotes. And the CKT is the net payment in the kth swap payment at time, in the swap contract at time t. And ZK is the position we take in the kth swap. So those are the variables we try to optimize. We want to optimize those Z, our positions in each of the quoted swaps. And what this constraint says here is that we collect these net payments, we collect whatever we invested yesterday in the overnight market, and that's the amount of cash we have to pay out the claim, whatever it is, and to invest for the next night in the market. So if a claim satisfies, sequence of claims satisfies this, it means that it is super replicable by trading in this market, in these simple assets. And here's the optimization problem we look at. So in this case, the function, the risk measure on the sequences of payments is chosen just as this. We don't allow any payments before maturity. So we would become infinitely unhappy if we had to make a positive payment before maturity. And at maturity, we just take exponential expected utility. And in that case, you can write the optimization problem like this. So this is just the budget constraint that we had in the definition of the claims we can superhedge for free. And what you do here is, if you fix your swap position, you can easily just roll this equation to maturity and get your random payment along every scenario. So we create some about 10,000 scenarios, and then for every fixed swap portfolio Z, it's easy to compute your net wealth at maturity. And then you try to optimize this expectation. It's very easy to optimize in MATLAB. It takes less than a second. And here's the optimal after optimization, the optimal payment profile that we have at maturity, with the risk aversion constant being equal to 1. If you increase the risk aversion, you see that the profile gets narrow and just reacts as you might expect to the risk aversion. So now we go to pricing. So that was the ALM model on which we built our indifference swap pricing. So we look for the least swap rate that allows the agent to enter the swap contract without worsening his optimum value in that optimization problem. And the first problem is this. We try to price one of the quoted options just to see if any of this makes sense. So what we try to do is we try to find the indifference price for the 6-month maturity swap on Eonia using this convoluted optimization and line search procedure that I explained. So let me explain that. So the way it works in practice, for every value of alpha, you assume that you can find the optimum value in the optimization problem that I had. And then you check if this inequality is satisfied. If it's not, it means that your alpha was too low. You have to increase it. But it's a one-dimensional search. So it's like a line search at every iteration of which you have to solve one optimization problem. And it's, again, very fast to do in MATLAB. Here are the results. What it says that the indifference swap rate is exactly the quoted 6-month swap rate for the swap. And that's exactly what the first theorem said, that if you have something which is replicable, then the indifference swap rate should be exactly the replication cost. And if you look at the portfolio, this is the optimal portfolio before we enter the swap, and this is what the optimal portfolio looks with the swap contract. And the only difference is in the last component, and the difference is exactly 1. So it just means that we hedge the claim by buying 1 unit of the quoted swap. So in this case, you didn't really need this indifference pricing. You just replicate it in the obvious way. But it's just nice to check that with this complicated, or what seems like complicated numerical procedure, you get exactly that. And now if you try to price like an OTC, something which is not quoted, the date here is 100 days, which is between the 3-month and the 6-month maturities. And now it's not so trivial anymore. Now the optimization really pays out. And you see that the swap rate that you get, the indifference rate, is in the same region as in the swap. You don't see the swap rates, but it's negative like it should. Remember, the overnight rates have been negative recently. And if you look at the hedging portfolio, it's different from the portfolio before the swap contract. And it's non-trivially different. I could have guessed that, what the optimal hedge would be. You do see that the biggest differences happen around the same maturity as in the swap that you're trying to price. And then, just to illustrate the effect of your initial position. So in the example that you just saw, I assumed that the initial position actually was 0. That was something that I wanted to emphasize in the beginning, that the initial position matters when you trade in the market. And here is the simplest possible illustration of that. If you have -5 units of cash today, you'd actually be happy to enter the swap contract to offset some of that risk. So you end up with the positive swap rate, which is very different from the negative rates that were quoted in the market. If I still have time, how much time do I have? 5, good. So I would now go to the 7, even better. Thank you. So the next example is this indifference pricing of S&P 500 options. Again, a very simple example. What makes this simple is that here we now assume that we are only allowed to trade buy and hold strategies. So we are looking at European calls and puts with a single maturity. And our hedging instruments are those puts and calls, as well as the underlying and zero coupon bond with the same maturity. So the optimization problem will be to optimize a finite dimensional portfolio vector which we hold over the next month. And then we see how much cash we get. Yeah, I should have emphasized this earlier already. The swap rate was easy because already also in that example there was only one risk factor. The only risk factor was the overnight index rate that you had to model. And here the only risk factor is the price of the underlying at the 30-day maturity. So it's always nice when you have as little as possible risk factors to model, just to sort of minimize the model risk. And I think in this example, I forgot to write down the number, but there's something like in the order of 100 options that you can trade. So you actually got the bids and asks from the Bloomberg data, and that's the prices that we trade at. So in this case, we are only looking at one period model, so there are two payout dates. There's today and the maturity. And the pairs of those random payments that can be super hedged for free is described by this. Is that those Cs that satisfy the budget constraints for some buy and hold portfolio. So this here is what you would pay to buy this portfolio. This is what you get by liquidating the portfolio at maturity. Where these functions S, J, 0 are simply you just look at the bid and ask of each asset. And if you buy the asset, you pay the ask price. If you sell the asset, you get the bid price. At maturity, we actually assume complete liquidity. So what we get, our assets were the cash, the underlying index, calls and puts, and these are just the payouts from those guys. So that's what we trade. And the optimization problem, again, unlike the exponential utility, you could use anything else. And again, we don't allow any shortage today. So we assign infinite penalty if there's a positive payment today. So in this case, you can again write the optimization problem with just optimizing the expected exponential utility from terminal wealth subject to the budget constraint today. And that's the ALM problem. And again, the optimal value is denoted by phi of C. So now, in this case, C is payment today and payment at maturity. And here is the optimal payout portfolio. In this example, we assume that, again, the agent starts with the 0 initial liabilities and just optimizes his portfolio in the cash, underlying, and the options. And this is the optimal payment profile as a function of the underlying at maturity. So that you can get by options and the underlying and cash. Here's the portfolio. Those are the amounts you take in the calls, and these are the positions you can take in the puts. I think that's cash or the underlying. Yeah, that's cash. There's 0 position in the underlying. And here is just an illustration what happens if you change your views about the market. If you assume that the volatility is 0.3 times the original volatility, you change your optimal portfolio to get this kind of payment profile. So you get nice payments when the price is close to its current price or the expected price. If you increase the volatility, it sort of inverts that. You now expect the prices to move away from the mean price, and then you want to get a portfolio that pays well then. And here are the indifference prices. It may be a bit confusing. What we did here, we priced a European call option using the other call options. In this case, the call option we are pricing is not one of the options, so you do get non-trivial prices. It won't be one of the quoted prices. And what we did here, we looked at the price as a function of how many units of that call option you trade. And this is price per unit in this indifference pricing. And then again, you can see what happens if you change your risk aversion. It happens like you would expect. The indifference price starts to move closer to the arbitrage bounds. It doesn't cross them. The arbitrage bound is this dotted line here. And this would have been the quoted price for the option. We didn't include that option in the hedging portfolio. Otherwise, the price would have been bounded by that. Then you can see what happens if you, you can see what happens to the indifference price if you change your views about the volatility. And again, this is under the P measure. There's no Q measures anyway. You could come up with the Q measure if you did the duality theory, but we don't have time for that. And again, the price increases with the volatility. And you can look at what, if you now had some initial position before the trade. Here we just assume that you have lambda units of digital option. And then you can see what happens to your indifference price as you change your position in that. So it's really like a simple computational tool that allows you to sort of get numerical values for that kind of questions. The last example would have been the computing the accounting values for pension liabilities, but I guess I'm running out of time. So here we are trying to hedge pension liabilities associated with Finnish males. And this describes the mortality risk there. So we model the uncertain deaths of the males. This is the median and, 90% confidence interval for the yearly pension payments. And you see that it goes to 0 when people start to die, and eventually it's 0 when all the males are dead. So we are looking at the fixed population. There's no new pension liabilities coming in. And then here we had more complicated asset model consisting of equities and bonds of different kinds and money markets and I think real estate and also like a multi-dimensional market model. And then we did this, instead of indifference prices, we are now looking at the accounting values. How much cash do you need to hedge these pension liabilities at a given level of risk? Essentially the Ars-Nedelban, Eber and Heath definition of a price. And then you can again look at what happens to the prices if you change the risk preferences and so on. In this case, the optimization part is slightly more difficult. You can't come up with very accurate solutions, so it's based on more of heuristics. You try to construct hedging strategies by some finite dimensional reductions of the problem. And so then you can do the mathematics. So up to here, I forgot to advertise that all the mathematics is really, really simple. It's just algebra and all the proofs are no more than 10 lines. Actually, there's a nice paper by Nicola Carouille and I believe her student Rouge from year 2000 where they did exactly the same. They had exactly the same result with the arbitrage bounds. The only difference is that I look at non-conical market models and it's just as simple as their proof. And then you can, if you want, you can go through the duality theory, and in this case you would end up with dual variables, which look very much like if you saw Lane's talk earlier today. He talked about the pricing kernels, which are like sequences of random discount factors. And you can go through, well, I have to mention this, there's a nice paper by Sara Biagini, Marco Fritelli, and Matteus Graselli, where they come up with a nice dual representation for the indifference price in a classical market model with a cash account and perfectly liquid assets. And you get these kind of results as special cases of these non-conical market models. You can also do the fundamental theorem of asset pricing if you care. But like I said, arbitrage is not that important. And in particular, the fundamental theorem of the asset pricing is not that useful when it comes to asset pricing if you are beyond the classical market models. And this is where I stop.
So we now proceed for the second speaker, Marco.